So we'll perhaps begin by asking the panelists to introduce themselves briefly and the institutions which they represent. If we could start with Daniel on my left and then moving all the way down to the end of the table.
Good afternoon. My name's Daniel Zinman. I'm not Mark Schmarman. Unfortunately, he's in the throes of hopefully signing a transaction at the moment, so I've stepped in on his behalf. I'm representing Rand Merchant Bank. For those of you who don't know, Rand Merchant Bank is the corporate and investment banking arm of the First Rand Banking Group, which is one of the big four banks here in South Africa. Unlike some of our competitors, we don't have the same brand across the various product offerings. So our sister bank is First National Bank. You'll probably see their ATMs around town, and Westbank is our asset finance business. We also have an asset management arm, Ashburton. Within Rand Merchant Bank, I sit in the infrastructure finance team, which really, as the name suggests, concentrates on all things infrastructure, so road, rail, port, logistics, PPPs, telecoms, energy, which includes renewable energy, and downstream oil and gas, all sits within our team, which consists of about 18 professionals in Johannesburg and 2 others who sit in Lagos and concentrate on West Africa. The last point is that we look solely at sub-Saharan Africa and have traditionally played both in South Africa and in the rest of sub-Saharan Africa, having recently closed a number of transactions in both West and East Africa. We predominantly provide senior debt, but also provide mezzanine and subordinated instruments to those types of projects, both project financings and funding to municipalities and parastatals.
And moving on then to Daniel. Daniel, if you could kindly share the characteristics and features that investors, whether global or domestic, typically, the type of features that they typically look for in projects across the continent. And if you could also then respond perhaps to sort of innovative funding structures that you look at as RMB on the continent, whether it's in the equity space or the mezzanine space in particular.
Sure, thanks, Madam Chair. So, as I mentioned earlier, we don't specifically necessarily concentrate on funding equity ourselves or providing equity ourselves, but we do provide subordinated debt and mezzanine instruments and senior debt to a variety of projects, parastatals and municipalities. So, I think we have got quite a cross section of deals and projects from which we can extract, I guess, probably not an exhaustive list of characteristics that we see institutional investors are looking for in projects on the continent, or at least specifically in sub-Saharan Africa. And I think that these characteristics can apply regardless of whether you're funding into you want to invest into a project, if it's some sort of parastatal or municipal instrument as well. And as I said, it's not an exhaustive list necessarily, but I think it is broad enough to cover most bases. I think generally, if you look at infrastructure as an asset class, it's not the type of returns that you're going to get from private equity or venture capital, and I think institutional investors understand that. So because you are expecting a lower return than what you are in, say, private equity or VC, you're expecting to take lower risk. So these characteristics are important, in my opinion, when they analyze whether or not to invest in specific projects. And I'll try to give a couple of examples as I go through some of these characteristics. In no particular order. So the first one is policy certainty and legal framework certainty. So if you look at some of the success stories on the continent, the first one that comes to mind is the South African renewable energy program. There was laws were put in place, a framework was established that really was the enabler and the catalyst for the success of the program generally. And I think it would be hard to argue that it hasn't been a success, but it was the groundwork that was laid by various arms of government acting in unison for the most part in putting that framework in place that I think largely led to the mushrooming of the sector and the success that they've had. The second point, and again, regardless of which sector you're looking at, I concentrate on the energy sector, so it may have that particular slant. would be creditworthy off-takers. And I think that if you look across the continent, hand on heart, there aren't a huge number of creditworthy African utilities. In fact, you can probably count them on one hand. And that's not necessarily in and of itself a deal breaker. Projects are done across the continent every single year. But you do need credit enhancement or mitigation tools to enable you to make that project bankable. So whether it's a government guarantee to the extent that the government is sufficiently creditworthy, whether it's support from multilateral agencies, DFIs, PRG programs from parties like the World Bank, those are the kind of catalysts that are required to I guess, start off a sector. One example I can think of is what's happening in Nigeria. The structure that's been put in place by the World Bank and its various arms has been successful. There was a transaction that we were fortunate to be one of the MLAs on, which closed in Nigeria at the end of last year. I know Helen's company was one of the sponsors there, called Azura, and that was really as a direct result of the reforms that had been pushed by the World Bank and the support that they gave to the various parties or players within that sector. The next characteristic would be a solid payment history. And I think there are one or two examples of where those sorts of payment histories are potentially wobbling across the continent now. But something like South Africa is an example where even when we got to the renewable energy program, there had been a strong payment history by government in its various, whether it was a specific department, a municipality, a parastatal, of paying under PPPs. So when it came to discussing whether there was a risk of Eskom or backed by the government in this instance not paying under an RPP program, I think there was generally a high degree of confidence that they would pay because of the history of paying under PPPs. The next characteristic would be the line of sight of a program. I think it's difficult for institutional investors to invest an enormous amount of time, resource, and capital in investing and bringing a project to fruition, because it does take longer in emerging markets than what it does in developed markets. And I think it's difficult for institutional investors when there's one lone project. When you can see a number of projects on the horizon or a program like what you're seeing in Nigeria, for example, there's a line of sight of a number of projects in Ghana. That incentivizes institutional investors, I believe, to dedicate resource, time, and capital to analyzing those projects. A small point is also the potential for upside in your project. As I mentioned, infrastructure assets have a general range of returns, and if there's upside potential by way of refinancings, expansion of plant to boost your equity IRR, I think that is attractive. And then I guess the last 2 points, which I know have been spoken about over the last couple of days. One is hard currency returns, particularly important, obviously, for global institutional investors. And that, again, is something that's been solved in a number of deals, whether it be in West or East Africa. There may be PPAs that are paid in the local currency but are linked to the US dollar. So in that way, the institutional investor who actually wants a hard currency return, in that case predominantly dollars, is able to extract that in spite of the fact that the actual payment is in local currency. Which I suppose brings me nicely on to the last characteristic, which is obviously political risk insurance. As I think Helen mentioned, there are some less, I guess, should we say, stable jurisdictions that some of us play in, and because of the long tenor that's required in infrastructure investments, you do need, both on the debt and the equity side, the ability to access political risk insurance, both in the public and private markets. So that catalyst that those entities bring to bear on these sorts of projects is obviously critical. And to be honest, I think a number of institutional investors would simply not look at projects if they didn't have that political risk mitigation. Thanks.
Thank you.
Doing business in Africa. You can't afford to be without Africa Investor.